Imagine waking up on a Friday morning, checking your phone, and discovering that your bank no longer exists. Your savings, your checking account, your business payroll funds, all of it locked behind doors that just closed permanently. This is not a hypothetical scenario. In March 2023, this happened to hundreds of thousands of people when Silicon Valley Bank collapsed in just 48 hours. So what actually happens to your money when a bank fails? And more importantly, how do you make sure you never lose a single dollar if it happens to your bank? Before we dive in, please remember that this video is for educational purposes only and is not financial advice. My goal is to help you understand these concepts so you can make your own informed decisions. With that said, in this video, we are going to break down exactly what happens behind the scenes when a bank collapses, step by step. We will cover what is protected, what is not protected, and the specific moves you can make right now to safeguard every dollar you have. I will also walk you through the Silicon Valley Bank collapse as a real-world case study so you can see how this plays out in practice. Make sure you stick around for the final section, where I will give you a simple checklist that could save you from financial disaster. Let us start with the basics. What actually happens when a bank fails? A bank failure sounds dramatic, and honestly, it is. But the process itself is more orderly than most people realize. When a bank becomes insolvent, meaning it no longer has enough assets to cover its liabilities, regulators step in. In the United States, this is typically the Office of the Comptroller of the Currency for national banks or state regulators for state-chartered banks. They officially close the bank and hand control over to the Federal Deposit Insurance Corporation, known as the FDIC. The FDIC is essentially the cleanup crew. Their job is to protect depositors and manage the failed bank's assets. In most cases, the FDIC will try to find another healthy bank to acquire the failed one. When this happens, you might wake up one morning and discover that your bank has a new name, but your accounts, your balances, even your debit card often continue working. The transition can be remarkably seamless. But if no buyer is found, the FDIC pays depositors directly from the Deposit Insurance Fund. This fund is not taxpayer money. It is built from premiums that banks themselves pay into, kind of like an insurance pool. Here is the critical timeline. The FDIC typically makes insured funds available within 1 to 2 business days of a bank closing. In many cases, it is the very next business day, so you are not waiting weeks or months. The system is designed to move fast. Now let us talk about the thing everyone wants to know. How much of your money is actually protected? This brings us to FDIC insurance, and this is where you need to pay close attention. The standard FDIC insurance limit is $250,000 per depositor, per insured bank, per ownership category. Let me break that down, because every word in that sentence matters. Per depositor means the coverage is based on who owns the account, not how many accounts you have. If you have a checking account with $100,000 and a savings account with $200,000 at the same bank, both in your name alone, your total coverage is $250,000, not $500,000. You are $50,000 over the limit. Per insured bank means coverage is separate at each bank. If you have $250,000 at Bank A and $250,000 at Bank B, you have $500,000 fully insured. Per ownership category, is where it gets interesting and where smart planning makes a huge difference. The FDIC recognizes different ownership categories: a single account, a joint account, a retirement account like an IRA, a trust account. These are all separate categories. So a married couple at a single bank could potentially have well over $1 million fully insured by using different ownership categories strategically. Now here is what is not covered, and this catches people off guard. FDIC insurance covers deposit accounts. That means checking accounts, savings accounts, money market deposit accounts, and certificates of deposit. It does not cover stocks, bonds, mutual funds, or other investments, even if you purchase them through your bank. It does not cover the contents of safe deposit boxes. It does not cover US Treasury bills or bonds you bought through the bank, though those are backed by the full faith and credit of the US government separately. And it does not cover cryptocurrency held at a bank. Let us bring all of this to life with a real case study: the collapse of Silicon Valley Bank. Silicon Valley Bank, commonly known as SVB, was the 16th largest bank in the United States. It was the go-to bank for tech startups, venture capital firms, and thousands of businesses in the innovation economy. On March 8, 2023, SVB announced it had sold a large portion of its bond portfolio at a $1.8 billion loss and needed to raise capital. This triggered panic. Depositors rushed to withdraw their money, pulling $42 billion in a single day. That is the fastest bank run in history. By March 10, regulators shut it down, and the FDIC took over. Here is what made SVB unique and terrifying. Approximately 94% of SVB's deposits were uninsured. That means the vast majority of account holders had balances above the $250,000 FDIC limit. We are talking about startups that had their entire operating funds, millions of dollars, sitting in a single bank account. Some companies could not make payroll. Some feared they would have to shut down entirely. The FDIC initially announced that insured depositors would have access to their funds by the following Monday. But for the uninsured depositors, the 94%, the initial message was that they would receive an advance dividend and then wait for the remaining funds as the FDIC liquidated SVB's assets. That is a terrifying position to be in, when you have employees to pay and bills coming due. What happened next was extraordinary. On March 12th, just 2 days after the collapse, the US Treasury, Federal Reserve, and FDIC jointly announced that all depositors of SVB would be made whole. Every single dollar, insured and uninsured, would be available the next business day. The government invoked a systemic risk exception, essentially arguing that letting those uninsured deposits vanish would threaten the stability of the entire financial system. And if you are finding this breakdown valuable and you appreciate this clear, in-depth approach, a quick click of the subscribe button below is the best way to let me know. It helps this channel continue to create helpful content just like this. Now let us move on to what is arguably the most crucial point. Here is the lesson you must take from SVB. Do not ever count on the government making an exception for you. The SVB bailout of uninsured depositors was not guaranteed by any law or regulation. It was a judgment call made under extreme circumstances. The next time a bank fails, and there will be a next time, there is absolutely no guarantee that uninsured deposits will be rescued. You need to protect yourself as if no one is coming to save you. So let us talk about exactly how to do that. The first and most obvious strategy is to spread your money across multiple banks. If you have $500,000 in savings, do not keep it all at one institution. Split it between 2 or more FDIC insured banks so that each account stays under the $250,000 limit. This is simple, effective, and the single most important thing you can do. The second strategy is to use different ownership categories at the same bank. Remember, FDIC coverage is per ownership category. You could have $250,000 in a single account, another $250,000 in a joint account with your spouse, and $250,000 in a revocable trust account, all at the same bank, and have $750,000 fully insured. The third strategy is to use a service like intra-FI network deposits, formerly known as CDRs or ICS. Here is how it works. You deposit your money at one bank, and that bank distributes your funds across a network of other banks in increments below the FDIC limit. You get one statement, one relationship, but your money is spread across multiple institutions and fully insured. This is especially useful for businesses or individuals with large cash holdings. The fourth strategy is to know the difference between your bank and your brokerage. If you own stocks or mutual funds through your bank's investment arm, those are not FDIC insured. However, brokerage accounts are typically protected by SIPC, the Securities Investor Protection Corporation, which covers up to $500,000 in securities if a brokerage firm fails. These are different protections for different types of accounts, and you need to understand which applies to your situation. The fifth strategy is simply to verify your coverage. The FDIC has a free tool on their website called EDI, the Electronic Deposit Insurance Estimator. You can enter your account information, and it will tell you exactly how much of your money is insured. It takes 5 minutes and gives you complete clarity. Let us bring this all together. The banking system is generally stable, and bank failures are relatively rare. But when they happen fast. SVB went from a functioning bank to a closed institution in 48 hours. You do not get a warning. You do not get time to move your money once the panic starts. Here is your actionable assignment. Before the end of this week, I want you to do one thing. Go to the FDIC website, use the EDIE tool, and check whether all of your deposits are fully insured. If they are not, start researching a second bank or look into the ownership category strategies we discussed. This is not about fear. This is about being smart with money you have worked hard to earn. Your money is your responsibility. The FDIC is a fantastic safety net, but it has limits, and those limits only protect you if you know what they are and plan accordingly. The people who lost sleep during the SVB collapse were the ones who had never thought about this before. The people who slept just fine were the ones who had already taken these simple precautions. If this video helped you understand something you did not fully grasp before, I would genuinely appreciate it if you subscribed to the channel. I make these videos to take complicated financial topics and break them down into language that actually makes sense. If that sounds useful to you, hit subscribe, and I will see you in the next one.